this is probably the 30th time I did this like live thing, or like not 30, but like I think 15, at least 15 times. Well, maybe not 15. Okay, 14 times I did this. I feel like every time I go on live, I'm still like having a major heart attack. But yeah,
It's easier to record, right? And then
totally. Oh my
yes.
God. Hi, Kelli. Thank you so much for coming on the show today.
Thank you for having me, Grace. Thank you for reaching out.
Okay, so I'm gonna read Kelli's bio for the audience. So Kelli is a partner at Cendana Capital, where she focuses on investing in early stage venture funds worldwide. Cendana's portfolio, including notable funds such as Forerunner, Uncork, Mucker Capital, among many others. So again, Kelli, welcome to Venture with Grace.
Thank you.
Okay, I'm sorry I had to make it so cringe, but anyway, so let's start with, can you share a little bit more of your journey into Cendana, and then, from Trinity Capital to, Cendana to like your overall career journey?
Yeah. So I actually am originally from Tennessee and Colorado, so I did not know what venture was. I moved to San Francisco right after college, and I got a job in traditional finance. I worked at Capital Group and Credit Suisse. But being in San Francisco, my friends that worked in startups were very passionate about what they were doing. And I loved talking to them about their ideas, the building, and realized I was really interested in working in what they were doing. So I founded a startup myself. It was called Dish It. It was point of sales analytics. It actually was around the same time that Square was starting. So it was a little early. It was focused on restaurants. Wasn't a great founder, to be honest. I didn't choose the right co-founder. Lots of things went wrong. But then I did join a startup that was successful. And, there I got to put my hands on every part of the business. And I think that was probably, one of the most impactful jobs I had. Again, I learned a lot through the founding journey, but also being a part of a startup. I'd known Michael Kem for 10 years personally and had the opportunity to join him and Graham. I had gone to Cendana events, and the ecosystem is just very collaborative and helpful. Like going to the events, going to their annual meetings, the summits they put on, the cocktail parties, like you always came away with people that had great ideas, wanting to help you. It just was invigorating. And so it was really exciting to have the opportunity to join them. And so I've been here now 6 years.
I wonder, so like when you joined Cendana, so Michael started this, I believe it was like at least 10 years ago. And then I wonder, like, you joined like maybe a couple years later after they started it. And when you joined, how was it like compared to now? You guys are one of the most famous people who invest in fund managers. So I wonder how did that all happen? And then you guys are kind of like a unicorn of like a fund, like who invests in the fund managers. So I wonder, like, what is that journey like to scale this fund?
Yeah. So I think it's totally kudos to Michael and then Graham. So Michael started this, actually, really the idea came around probably 2010. That was his first time he had been an LP for the first time in his career when he was on the board of the San Francisco Employment Retirement System. And that's when he saw the dislocation happening in a venture, and seeing that and spotting that and believing that seed was going to be de facto early stage. He was right. And so, that's Cendana's origin story, and it's where we stay true today. We're very disciplined on the earliest stages. Graham joined a few years later. He had a thesis about small funds outperforming early stage. He had been at Horsley Bridge and Cambridge Associates, been in a startup himself. And so he actually proactively reached out to Michael because he believed in the thesis. So when I joined, again, it was more about the ecosystem. I didn't know enough. I'd never been on the LP side of the table. So I wasn't buying into the thesis. I was buying into the ecosystem they had built and the team I was going to work with. And, again, it was 3 of us. We're now 8 people. So we've scaled. We just closed, last year we closed Fund 5. We were investing out of Fund 3 when I joined. We launched international. We started investing internationally when I joined. We launched a nano product. We have a joint venture on a secondary fund now. So we definitely scaled the product offering, scaled internal operations with data. That actually has been a big focus of mine, was focusing on data. So we have really great access to data. And I think all endowments, foundations, fund of funds, even venture funds, it's how do you best structure your data? How do you stay on top of it? And I think, we really utilize the data to make sure that we're, what is working in the portfolio, what has worked, being able to back test, being able to spot trends, being able to be a better underwriter of funds pitching us based on the data that we have in the portfolio. So we try to get as granular as we can into the KPIs of the underlying companies, the fund rounds, the dilution those companies have taken, what the financing path could look like, to really understand what's going on in the underlying funds portfolios. And again, having real visibility when people pitch us, and being able to benchmark it against what's worked and what hasn't, in our own portfolio. So I think, Graham and Michael had done a great job of tracking data that they had, but I was able to scale it up into to a database, that we really utilize now. And I think, obviously it's very different being 2 people to 3 people, much more collaborative, much more people just owning things. We still like to operate as a startup. Everybody can have hands on everything. There's ownership of specific things, but we want everybody hands on everything and know all parts of the business.
Totally. I really love that, like, you came in and then you brought your own set of like value, which is like, you created the database and then you're like taking care of the data part of things. And I wonder, like, what does that entail? Like, let's say, I know that your fund is trying to meet with everybody who will reach out, or like everybody who has a fund, to see everything in the market, which I think that's super smart. But seeing so many things in the market, it's like really hard because of like, number one is like the time commitment, as well as like there's like, too much data to be like input into a system to be like, hey, let's track this like 5,000 funds, like what, like Michael said in like other interviews, like everybody and their sister has a fund nowadays. Like, how do you what are benchmarks that you use to track like which fund that you decided to go invest?
Well, so I think we definitely want to capture who we've talked to. The notes are really important to make sure, like, why we passed. And, if something worked, you want to be able to understand why we passed, or, what we thought was great about it, because we are comparing notes with our own LPs that are investing in directly into funds, or collaborative LPs. And so we're sharing this information. So there's a lot of qualitative data that we track as well. I honestly don't think that there's a limit on what you should track. It should be everything you can get your hands on. And it's a real focus of ours on how we're going to scale our data team and structure, because it is important that we have all of the knowledge that we can. I think it's easier than ever. And that's a project we're undergoing right now. Data lakes is what we're currently setting up our own data lake. You can use AI. So we're really focusing on the scalability of the data now where we are. We have over 4,000 underlying companies. Obviously, our own investments, priority number one, like tracking the companies, the portfolios. But as you said, the people who are pitching us, right? So they go into the system. We want to make sure we know how many funds we've talked to. If you ask us about sustainability funds or cyber-focused funds, we should be able to name the ones that we've spoken to and, what the reasons we passed, right? We should know where we're seeing trends of, we need to market map. If we are going to invest in a fund, we need to make sure we've talked to every deep tech fund out there, and that we understand that this really is the best GP to be addressing the market. So, I think there's no limit on what we should be tracking, and it's just making sure that we have the correct processes in place and team in place to be able to scale that data. Again, it geometrically expands because tracking our own portfolio, right? 4,000 companies, hopefully they're raising rounds, activity still happening in those companies, funds are coming back. But we're really trying to do a better job, trying to do a great job of tracking intros that come in, put them into a pipeline, and make sure that we're tracking them all the way through.
Okay, so I'm gonna dig deeper into this like database creation process. So basically, okay, as a tiny tech angel investor or whatever, like writer, or so basically, when I track certain category to invest in or something, it's more of it's a little bit chaotic, but like, we could categorize them into like the founder experience, product, and like, what market are they in, what's like, good or bad about this company, and then what does a perfect outcome looks like, or what is a terrible outcome look like? So those are like my mental benchmark. And then like I have like an Excel checklist of the company that I have met. But I wonder, and then also there's like a group of company that I heard about it out in like a dinner conversation or over the news or something that like have a strong signal of this is gonna succeed, and then this is like my target list. And then there's like a bunch of things that are like in my inbox that are people sending it, like friend of friends started a company, blah blah blah. So I wonder like how, based on like the deal sourcing as an LP, how do you go about it? Do you go reach out to the people at an established fund to be like, hey, if one day you're leaving XYZ, like let us invest in you? Or do you go about it like, okay, so here's like our current portfolio funds, and then they made an intro to this other fund, like I should take a look at, like how do you kind of do the deal sourcing, and then how do you, yeah, I guess like what does your database look like in terms
Yeah.
of the category of things that you
So I also want to address what you just talked about sourcing for yourself, but I'll talk about our sourcing and then we can talk about the sourcing of the underlying GPs. I think our top of funnel, because we're so disciplined and we focus on seed and pre-seed only, and people know the portfolio, we don't have a lot of outbound. That being said, we do a lot of calls with collaborative LPs, meaning endowments that also invest in seed funds, compare deal flow. We have our flywheel spinning at this point, right? So we've invested in 70 funds. And we started the Nano program, which is that sub $20 million fund where we anchor the smaller funds. And so we have GPs that are co-investing. We are on founder reference calls, right? We do as many founder reference calls as we can per GP. And so you're hearing about funds consistently. If there's one that stands out of founders talking about it in multiple calls, then we may target like, hey, who is this person? We should get an intro. But for the most part, I think because where we sit in the ecosystem, the top of funnel is pretty full. But I would say, it does come from founder reference calls, our own GPs, right? We're talking to them. Who else is on the cap table with you? Who do you want to bring into the round? And we also have relationships with downstream capital. So who do they think is a signal at seed? Who do they think has really strong deal flow or, great companies in their portfolio? So I think we get it. We also have an advisory board of 20 people of, established VCs, entrepreneurs, people in the ecosystem. So again, the flywheel is spinning. We have 4,000 companies. We've talked to a lot of the founders in those companies as references. So I think we have the flywheel spinning of where the deal flow comes in. And so again, we're tracking it through the database. There is the cold outreach. That's harder. Again, we have the number of LPs we have also didn't pull them in. I think collaborative LPs, our own LPs, we are consistently in communication with. And so, I think through that, we see everything, or majority, we feel comfortable with our deal flow. I think it's important to get an introduction, a warm introduction to us, because we do have such a big ecosystem. You should be able to find somebody that's connected to us where they can recommend that we speak to you. It's hard to deal with the cold outreach, simply just because of, as you said, the cold outreach in your own inbox is hard to track. The deal flow that you're talking about and tracking, I think it's very important that when GPs start, that they're treating this like a business. It's not you're just making one investment. Like, how does this actually work going forward? And just like we want to back test our investments or understand why we made decisions, what worked, is understanding, where deal flow is coming from, right? You might put a lot of effort into one way and you actually realize a percentage, the highest percentage of quality deal flow is coming from a different avenue. And so then you would want to lean in. You might qualitatively think that, but being able to see the numbers and being able to see the relationship mapping and where things are coming from and where to spend the effort is really important in understanding how you can continue to have quality sourcing and your own picking capabilities. So I think it's really important setting up your own internal database and processes to be able to manage your own portfolio, understand what's working, what's not, modeling the portfolio as you invest as well.
Totally. I wonder, as like you guys invest in so many amazing fund managers, and I wonder, like, when they come into the pitch, right? Like, so what are things that you feel like make them special? Not just a pitch, but like, I guess like throughout your due diligence process, I think you mentioned about like Kristen Green, when she came in, like, you guys called the people from Warby Parker. People are saying like she is the first person they would call at like 5 a.m. or like if something happens. So basically, she's a really supportive, like fun, basically investor to the startups, right? So that's like how people do due diligence, do checking with the startups. um I wonder, like, when you're looking at the new round of the new Kirsten Greens, like in the current ecosystem, what are the common things that they have, they're sharing? And then also, like, as you know if we're looking at from a small investor perspective, like, a lot of people's thinking framework is, can we co-invest with the Sequoia of the world, like, or like basically, you kind of like track who is the top current investors in your space, right? And then you kind of like figure out what's their investing pattern. And I wonder, is there an equivalent in the LP space to track, like, who is the top fund managers, regardless if we invest in them or not? And what does that like ecosystem look like? And then, um, yeah. So I'm sorry, like my question is so like
Yeah,
I
no,
have no
so
comparison.
yeah.
Yeah.
So okay, so breaking it down, it's what we think is special, and then how do you track the outside ecosystem? Let's start with the second part. The outside ecosystem of where we're not invested is much more difficult to track, other than if we think they're interesting, we'll continue doing update calls. 95% of our investments have been to fund one or two.
Mm,
So it would be more likely, it would be hard for us to enter at a fund three, but we still stay in contact with ones that we think are interesting. So we do get updates and we know how their portfolios are progressing. But there isn't a great, that's why I did not spend a ton of time integrating any external third-party data sources, just because it's, there's confirmation bias, who's actually giving the data, what data is correct. I just don't trust it. And so, it goes back to tracking, talking to LPs, knowing what's working in their portfolio, and understanding what's worked and what you think why. We have enough data points in our own portfolio to kind of suss out what we think are trends. The trends are that smaller funds outperform, which was Graham and Michael's thesis was early stage and small funds, correct portfolio construction. I had to buy into it, but it definitely is something that our data shows, right? Funds 1 through 3 and small funds outperform in our data sets and what we can get our hands on. And so, that's our own looking at the data and what we see, trying to find like the characteristics of what makes somebody special. I wasn't around yet when Michael made the investment to Kirsten in Fund 1. But I think, my own experience, I did a brief stint at a venture debt firm right before joining Cendana. And I called on her, right? I was trying to find deal flow, and I called on her and she took a meeting with me. And I think, there's something about the way certain people make you feel heard. They take every meeting, they, have a presence. There's just a certain gravitas and specialness to a person. And I look at many of our GPs today, and they have that same characteristic. They're not talking at you. They're really bought into the conversation. They're learning, right? They're eager to learn from you and curious. And so they take every meeting. They're very, there's a superpower to them, right? There's a special factor. I've always thought, like, is it organization that they're just more organized than I could ever be? Like, what about it? And I think it's different for every person. I think, different people have different strengths. And so, like, what is that special strength that could lead to outperformance or making them like, very successful? One manager that stands out to me right now, we do monthly calls with each of our managers. This is to help them with their own building of the firm, their own portfolio, and for us to have insights into what's going on and to better know our own investments. And through that, we have one manager, it's a nano fund. And so it's his first institutional fund that we were and he ran all these different experiments of sourcing, right? And hearing him take the feedback and then implementing it and being thoughtful, they're not thinking, okay, this is how people source and I'm going to do it, but I'm going to do it incrementally better. They're just doing things differently, right? They have a thesis or a way of operating the fund or a thesis on where they're going to invest or companies that they've invested in that's just different. It looks not like the consensus of every VC, of every fund we see. There's something different about them as a person, their network, their thesis, or the way they're going about investing. It's not what everybody else is doing, but we think it's going to be incrementally better. Most of the time, it's very different.
Totally. Okay. I want to say hi to the audience, Charles and Savannah. Thank you so much for coming. So I think you mentioned like something really great. It's like, one of your the fund manager that you invested in, they're really good at like testing things out and then like hearing feedback from you guys. And I wonder like, when you're looking at people without much track record, like what does a typical track record look like? Oh, hi, Colin. So, what does a typical track record look like when it comes to like the most successful fund managers? Like, do they have, let's say, 7 syndicates, or like, like they're scouting for Sequoia, or like, they, basically they're like a super successful angel, or like they just out of school, like, and then they just have a really good like network. What is like the common background of the most successful manager look like? And then also, why do you think that makes them successful?
Well, so our oldest funds, rolling funds, were not around by then. We won't invest in a first-time investor, so there is some type of track record there. So they've been able to make a few investments. I mean, more than a few. We've done a few light track records, but that's really an exception. But a lot of the times, the portfolios aren't mature enough yet to like. They have this great DPI, and we know that they're going to, be persistent of returns. So, when I look at it, what makes the successful track records? What does it look like? There's not a common denominator. It really isn't. I do think you need to prove that your network is going to give you the deal flow, right? Like why, and this is why we think, we can debate right now about why funds 1 through 3 outperform. I think, internally, obviously fund size is smallest, that's the easiest, but I think there's something about the lowest hanging fruit of the network, right? It's the immediate people in your network. And I think there's Reid Hoffman that said, there's the common thought, it's not what you know, it's who you know. But I think there's Reid Hoffman that said, it's not who you know, it's who trusts what you know. And so I think that's important, right? Like you might have come from Stripe, but who did you work with at Stripe? Who is going to want to work with you again? Who's going to be the call, right? So I think it's digging a level deeper than just, okay, you have access. I think, we want a track record to understand your thought process of where you met them, so network, and really your thinking on like making the investment. Like, what was your thesis? And so we can understand your picking and how you think. There's not going to be exits a lot of the time by the time we're investing in an emerging manager. It's very rare that they have that length of a track record, to be honest. That's more rare. So the track record for us is to show, the network and the picking, and the winning. Even if it's a small angel check, like why were you chosen? And we can talk to the founders about that.
Totally. Okay. So one of the audience, Colin, is asking, what would you define as a light track record? I will go into my question later. Maybe we'll go for this question first.
Yeah. Light track record. I think, I would say you need to have a few years. It's not just, I started investing 6 months ago or in the last year. I think it needs to be that at least you've had some time to see like what the progress of those companies have been. And I would say, anything under 10 would be, you need to build further on it. Yeah. So I think there needs to be, you need to give yourself time right? You're not, oh, I did something for 6 months and I'm an expert now. You need to be able to take that feedback and iterate on why the investments you made in the last 6 months differ, or where did you go from the first investments you made in your track record.
Mm. I wonder, so like you talk about three things, right? Like there is your network, your picking, and your winning ability as a fund manager, right? Like let's talk about network. I feel like we both live in Silicon Valley, as of like the ecosystem is like so robust. Like so many people have encountered, a TL fellow or like YC founder down the street. And like, I wonder, how do you define a good network? And you mentioned about like, let's say the early Stripe founders, or like in your, like in the other interview, you mentioned about like let's say like like people invest in like three like Uber early employees or whatever. So I wonder, like, I feel like the network is really hard to define. And then it's like, if you're just the early Uber founders, or like if you just invest in the early Uber founders, or like you are a early Uber founder who is investing in other early Uber founders or whatever, I feel like it's hard because you don't really have the longevity to go about this existing network. So, for example, like let's say if you came to ASAV at a certain time period, I feel like unless you are super great at networking all the time, you're constantly reinventing yourself into the ecosystem, I don't think you can keep going on with that group, because that group of people may already kind of like having some sort of exit, or like, your friends, it's too late to invest in them, or like, you already invest in them. Like it's hard to like for you to run a fund based on like your existing network. And I wonder, based on your observation of the current fund managers, how do you define like people that with a good network? I'll go into picking and winning a little
Yeah,
bit later.
well, so let me give you a example from a reference call. We did a call on Katie Stanton at Moxie.
Mm,
Um, and when we talked to the founder of a company, he said, you'll never meet anybody with a network like her. And he gave specific examples. He wanted Joe Biden to participate in National Day of Prayer. She got Joe Biden's office on the phone. He wanted the Vatican for something, and she got the
mhm,
Vatican on the phone for him. So I think there's just like, you can talk to founders and realize like, okay, their network is helping the founders, and that founder will recommend all of his friends talk to Katie because of the value she's added to the company. So I think, you talk about like, okay, well, yeah, they're not going to be the
mhm,
founders out of Uber anymore, right? All those people have aged out, or you've already invested in them, and that goes back to our first part of like why funds 1 through 3 outperform, right? It's the low hanging
mhm,
fruit of your network. These are people you work directly with. It's your time to
mhm,
start a fund. It's their time to start a company. It's the low hanging fruit of your network, and so you do have to iterate if you're going to create a brand. How do you get that flywheel spinning? And it's
mhm,
really adding value to people where they're going to recommend that you work with them. And so it's
mhm,
leveraging like, what is the value you're bringing to companies, right?
mhm,
We have one manager who focuses on go to market. We have
mhm,
former founders. Like everybody has whatever your skill set is, if it really adds value to companies, if you're helping, we have one manager who focuses on hiring. If you're placing employees, which is like
mhm,
one of the most important and hardest things to do for early stage startups, if you're getting them hires, if you're getting them revenue, like
mhm,
these are things where they're going to recommend you to their founder friends. And so eventually, the best referrals you'll get as a VC are from other founders, right?
mhm,
And so adding the value to the founders you have worked with, or adding value to people who are starting companies, even if you didn't invest in them, that's the best way you can get referrals. And so
mhm,
it's other people on the cap table that are going to recommend like, hey, I want to bring you in because you added so much value to the company. I want to work with you again. This is another company I want to work on. So I think it's really that, as much as it's a network, it's like it's not who you know, it's who trusts what you know. And so it's
mhm.
the value of that you're going to bring.
Totally. I would totally wanted to go into how does she build the network to get like, Joe Biden's office on the phone right away. Uh, but yeah, I wonder, like, in terms of you just mentioned about like, she's getting a great reference from the founders, and like, in the founder space, I heard VCs were seeing like, the best founders are not necessarily the people who are got like a positive feedback from their past like boss or something, because some people who may make a really terrible employee but a amazing founder. Like, I wonder, does that apply to the fund managers?
Um, I mean, we've heard negative references before. I think it depends where we're getting the negative reference from, right?
Mhm,
Again, I would say if you look at our reference memos, there's 40 plus reference calls at minimum on each of those. And so you're bound to hear some negative things. We always ask for constructive feedback to
mhm,
understand like where they think they would need to work on to be able to scale and do their job best. Um, I think you can read through, right? Just like I can read through a founder not saying anything negative, but
mhm,
you can't give me tangible examples of how that VC has actually helped you. Yeah, they answer the
mhm,
phone, they're great, but if there's nothing you can tell me that they've actually done that's been meaningful to your company, then, you know, they're solid, but they're not going to be the absolute first call that you tell your friends to make. And so I think it's almost not even the negative, it's the neutral that you have to look for. And if you do enough reference calls, you can really pick out which ones the founders are like pounding the table, like this is the person I
mhm,
want to work with again, and this is the person that
mhm.
I'm going to send my friends to.
But what if, like, the founders are like, since, like, if a lot of people maybe investing in the founder at a really early stage, and then you may be the smallest check in. I know, like, Kristen Green was a small check into Warby Parker. She made a huge contribution, all that. But when you put a tiny check in, the founder may not really take you seriously if they already raised from some top funds or whatever. Like, when, like, obviously, if, like, someone giving the founder a call, like, to be like, hey, did XYZ add any value? Like, the founder would be like, they wouldn't say bad things, because of, like, they would be like, oh yeah, like, blah is great. But, like, I feel like it's like, when the check is so small, it may be tough to be
Well, and I think
conscious.
that's the difference if you want to make venture a career versus remaining an angel investor. Like
Mhm,
you have to start building that track record
mhm,
by making a name for yourself by adding value, right? So like
mhm,
if you're going to angel invest, like they want you on the cap table for your name, your network, whatever.
mhm,
Sometimes it works out. Most of the
mhm,
time it doesn't. When you talk to them, there's like, oh, there's one or two of the 50 angels I took that actually
mhm,
added value. And so we're looking for those one or two that added value, right? I mean,
mhm,
we're looking for not, I don't want to use the pejorative term, but like spray and pray. We have a thesis on portfolio construction, which
mhm,
is high conviction investors. We want people who can get enough ownership to fund size ratio where it's going to be meaningful to the fund if it is an outlier company. And so if you're going to
mhm,
be able to be an angel that's invited back, to be recommended, to be allowed to get more ownership of a company, you have to add value, right? It
mhm,
just, they're not going to do it out of the kindness of their heart. It really has to be what's
mhm,
best for the business. And so, um, if you want to set up a venture track record, it really is like, if this is your bet, like, how can you help this company?
mhm,
And if it just has to be a priority because that's we talked about sourcing,
mhm,
picking, winning, but the other huge part is supporting, right? And we that's how you're going to going back to the sourcing. If founders are going to recommend you, or other VCs are going to recommend you, which are the two best ways of deal flow, then you have to add value. And when we talk to when we're referencing nano funds, a lot of times they're angel checks, or they had a $5 million fund, they're wanting to raise 20, and they punched above their weight, well
mhm,
above their weight on their check size, that they are extremely valuable. There's usually a lead, and it's like the lead didn't even do as much. The institutional
mhm,
seed fund or the institutional multi-stage fund didn't do as much as this angel did for me and for the success and where the company is today. And so that's what we're
mhm.
looking for, that type of information on the VCs when we're talking to founders and referencing.
I want to get into, like, the, like, niche or non-niche part. So, like, I know you guys invest in, like, so many funds that are focusing on so many different sectors, and, like, each, like, portfolio manager, like, each, like, fund manager have their own specialties and strength. Uh, you know, when people, like, building up a portfolio, when they're, like, angel investing, or, like, putting up, like, a small portfolio on their own. Like, I feel like unless you're like a seasoned operator in XYZ category, it's easier for you to pick a niche. What's your suggestion on picking a niche? Because I think nowadays, like you can see, like if you're investing in AI, there's like 7,000 investors who are in this area to compete with you. And I wonder, like, how would you go about creating your own niche as a fund?
I think going back to don't do what everybody else is doing and
Mhm,
doing it incrementally better. I think it has to be 100% authentic to who you are, what your background is, what your strengths are. So
mhm,
sometimes that is a sector specific fund, right?
mhm,
As you mentioned, AI. You have to be a technical person or you have to have a background there for it to be
mhm,
applicable. And so I think if it's sector specific, we have to really think about why you are going to win over a generalist in a
mhm,
sector. Is it because the companies have to sell into certain, in health tech hospital systems and you have connectivity
mhm,
to the payers and, like it has to be a reason that you're going to win in that sector. Um, we have supply chain logistics funds and it's understanding that sector and the buyers and the go to market really well, right? And so
mhm,
I think you can't just be a sector because it's an organizing principle and that's your background. It really has to be why that gives you a right to win with founders.
mhm,
um, and then as far as skill sets, I do think that's another way, right? We have a manager that's great at storytelling. Storytelling is a huge, technical founders aren't always the best storytellers, right? And so they
mhm,
do need help. Every part of, starting a business, selling to customers, raising money, it's all
mhm,
telling your story effectively.
mhm,
Go to market, helping companies with go to market and understanding the playbook if they've never done that before. So I think you could have a specific skill set that you're really leaning into,
mhm,
that allows you, sector specific, skill specific. It depends on what you're trying to be your competitive edge and where your value is. I do think there's some very niche sectors, and we're just not going to invest in it. It's there's a lot of debate: is generalists better than sectors? And there's debate internally about it. There's debate with
mhm,
our own LPs. We talk about it a lot. Our generalist funds have performed well, right?
mhm,
Our sector specific funds have performed well, but again, it can't be too niche where you're creating a lot less deal flow, right? Like
mhm,
you're creating a very small universe if it's
mhm,
really niche. And you have to have a right to win. It gives you a right to win because you're an
mhm,
expert in that sector. There's something about that sector and your experience that gives you a right to win in that sector.
mhm,
And if it's a technical space, you need to be technical yourself so that
mhm,
you can diligence the opportunities,
mhm,
and talk to the founders in their language as well. So it really
mhm.
just has to be authentic to the person and leveraging their skill set or their background on the sector expertise.
Totally. I like when you mention about, like, let's say you have one of the portfolio. Oh, well, you have one of the like fund that you invest in because of like the founder who's really good at storytelling. Not the founder, but like the founder of the fund is
Mm,
really good at storytelling. I think that's a really hard benchmark to sell because like what does that translate into money, right? Like, so eventually, like in the end of the day, to invest in these funds is to like make money for the LPs. And I wonder, like, how do you guys kind of like creating that benchmark to evaluate, to make sure that this is like works for from like the monetary perspective. How do people, I guess, like, because these are like soft skills, obviously it's very
mm,
very important skill, but I feel like it's really hard to measure because I feel like there's so many people who are just amazing at sales, but in the end of the day, are they good investors?
correct. And that's where we have to spend the time, right? There has to be a track record to kind of
Mhm,
understand your thought
mhm,
around picking, why you
mhm,
chose that company, what was your thesis around it, how has it actually played out, what
mhm,
hasn't worked out, what was your thesis. And I think not enough people do that, right? Like
mhm,
they keep things that are even zombie startups, what I'll call
mhm,
them, right? And they haven't been marked up
mhm,
or what, they likely are dead. And they're not like, hey, I learned this. This is what my thesis was at the time, and this is what I learned. And so I think
mhm,
that's an even better way for us to learn that you're learning and your
mhm,
train of thought. And I think the more transparent you can be with your thesis on your underlying investments and what made you think this was the right place to put money will always help us understand and give confidence in your ability to pick and be a good investor. I think it's the train of thought. There's a few managers that just really stick out on, when they came in, that they stood out because their thesis was so clearly articulated, and the way they spoke about companies and why they invested in that certain market, that certain opportunity, was so much deeper than, oh, it's this founder, they're going after this company, and this is what the company does. Where when managers can get into it, when they're pitching us and they're telling us, this is the market size, these are the other players, this is what they were disrupting, they really know the investments in the company and they can articulate it, then you can understand their investment mindset and their thesis and their due diligence and their underwriting so much better. And that gives you confidence in, how they will be as an investor.
I wonder, I'm like literally taking notes, and then I have like so many questions whenever you're talking about this. So okay, so let's jump into like the picking part. What kind of founders or like fund managers that you have invested in that are having a really unique picking advantage?
Picking advantage.
Like they're really good at like so I guess there's two type of people, right? Like one is like the people who with a mega network, and then they just kind of invest in like what's popular, and then like I put them into quadrants, like the visible good company, the visible bad company, the like non-visible good company, and non-visible bad company. You obviously try to
I think one that totally stands out then is Mucker. I mean, at the end of the day, right now, all of our managers, if you're investing at the earliest stages, the multi-stage funds now all have programmatic seed funds. So if you're just looking for a second-time founder, you're going to be competing on price, and it's not going to make sense for a small fund, the economics, the way it plays out typically. And you're going to be competing, if you have a large enough seed fund, you're competing, and it just doesn't make sense for your fund portfolio construction. So you aren't looking for the consensus, right? And so Mucker started, and it was focused on LA in 2011, 12. That wasn't consensus back then, right? Like LA wasn't known as going to be a tech startup HubSpot. And so they have always been the non-Silicon Valley. And so for them, looking at their deal flow and what they've done, the amount of successful companies that have come out of their accelerator and their fund is absolutely phenomenal. And they're not chasing any of the unknown entities or the Silicon Valley network. And so I think, it's always, we break our portfolio up into pre-seed and seed. Seed has some traction, some revenue, some customers, or there is a, there's something to diligence there, or we go back to it's a second-time founder that can command $6 million, whatever, plus out of the gate. Pre-seed is really, they're identifying people at companies and they're working to pull them out, or they're identifying people that have this idea and helping them craft the idea and betting that they can make that idea a business. And so I think it takes a unique skill set of soft skills to really understand, what makes a founder special and who has the right idea, because again, it might be the idea they start with. They're going to have to iterate. There's no business plan where you start with it and that's exactly what you end with. At the end of the day, you exit. And so I really think it's this being able to identify great founders and great people. And if you look at our portfolio, Mucker continuously does it, and it has a persistence of returns in their track record of huge outlier outcomes.
Yeah. Hi, Monique. Hi, Himale. So I want to pronounce it right. Okay. So Mucker has a reputation of like kind of A6 and Z, but outside of Silicon Valley kind of thing. So I wonder, like, how do you like, so basically when you guys pick them, they probably don't have like the kind of cachet right now. So I wonder, like, when you pick them, how do you spot like the differences between them and like other funds?
the same way they pick founders versus other founders that become unicorns. I do think it's a lot of time of just the soft skills of, are they a moneymaker, right? I think we spend a lot of time on motivation, right? Like, is this someone who actually is better suited for the later stage? A lot of the early stage GPs have walked in the shoes of founders. They know what the 0 to 1 is, and they know what the 0 to 1 takes in a person, and the grit and determination and the skill set needed to accomplish the 0 to 1 to build a business. And so a lot of them are former operators and have done it themselves because they need to be able to identify what makes that in a person. And I think that's what we try to identify in them, is like, do they have that EQ and knowledge base where they're going to be able to identify the right people? Are they assessing people in the right way? Again, we're investing in a person, right? We're not investing in a business, a person in a business, or even an idea. I mean, it's somewhat of an idea, but it's a blind portfolio and it's a relationship. So the other thing I would add is that we have to like the person, right? I mean, if we just did one fund, which we don't love to sign up for, right? We want to do multiple funds. And so it's a, multi-decade relationship, and we want to make sure we like working with you. I think that's important because, again, founder referrals, going back to this founder referrals, people have to like working with you. And I think it may be different at later stages. It's about, brand, halo, etc. But at the earliest stages, you really have to like working with the person. You're in the weeds, and hopefully they're adding value. And we feel the same way about the GPs back.
Totally. I like when you
They're
said
all nice people.
Yeah, they're all nice people, and you have to like them. I wonder, like, at this point, you like them. How do you win the deal? Like, I feel like for LPs, like, it's a no-brainer. I feel like it's easier to like win that stage because of like you guys are kind of the one of the like only big players, and like LP, like you guys are LP, right? So I wonder, like, for GPs, like when you see so many funds, like what is their kind of particular strengths? What is like an interesting fund that you've seen that are like amazing at winning deals? Like they're competing with all these big players and then they eventually win.
I mean, one of our fund managers spoke to him a few weeks ago, and he beat out what I would say is like the number one seed fund that you hear about. And he got on a plane and went to New York 4 times to meet the founder in person. They treat their own businesses as startups and a business, and they go out and hustle. And if they want something, they make it work. And so they're selling themselves. I think, if you're competing head to head, we're not necessarily looking again for the people who are competing head to head with the name brand Silicon Valley firms, because then you're competing on price, which doesn't work for the portfolio construction. But if you're competing against just, in your ecosystem, again, it's like you have an expertise on a sector, an expertise on a skill set. The founders in your network are going to like proactively call the founder that you're pitching and be like, you have to take money from this GP. They helped me land all my, my first 3 revenue deals. This GP got me my first 4 hires. Like that's what the other founders in your portfolio are going to call the one that you want to land and tell them. And that's how you're going to win deals.
So basically, I feel like it's like huge amount of like hustle, and then like I really like that when you said like they treat themselves like a funder, and they have to really go out there to like compete with everybody else. Speaking of that, like, so speaking of like there are amazing fund manager who are great at picking, some are really great at winning, and then some are really have like a just amazing network. And in terms of being an LP, what does your portfolio construction look like? How do you pick, like, there's so many, you just seen so many talented people, and then if they come to you, and like if you're already encountering with them, they must be so exceptional at something. And how do you kind of like using like what benchmark to kind of like, putting money into these different funds?
So I think what you mentioned, we want to see all of those, right? We want to see that you have an incredible network, that you're fishing in the right ponds, that you're great at choosing uh, which ones to actually go after, and then that you're capable of winning them, pulling them in. So we want to see all of those, not just one of those.
Mhm,
And I think for us, our own portfolio construction is that we have the same conviction that we want to see from the managers, the portfolio construction we look for in ourselves. We consider
mhm,
ourselves a lead investor. We do monthly calls with our managers. We're hands-on. We want to be supportive. And also that look through ownership of a company for us matters, right? In our first fund, we
mhm,
have one company that returns our entire fund of funds. So we want to make sure that our portfolios are constructed in a high conviction manner as well.
mm,
And so, I think what it means now is that we look, it's not top down. It's not like, oh, we don't have enough fintech, we're going to go find fintech. It's not meant to be that way. It does
mhm,
mean that, oh, we have enough enterprise infrastructure at this moment, like we would have
mhm,
to cut to add somebody. So we
mhm,
do monitor sector wise, we do monitor geo wise, like, do we have enough exposure there? If we added, we might be a little overweight.
mhm,
um, so we do monitor the portfolio in that manner, but it's not meant to be prescriptive about
mhm,
that. But we also spend a lot of time looking at what the overlap of companies is, right? We don't want
mhm,
at a fund manager where 50% of the companies are going to be redundant. We
mhm,
want to see something accretive to the portfolio, new shots on
mhm,
goal. And so with that, we really look at, what the networks are, what the overlap is, what the co-investments, what's in the portfolio versus their current portfolio, and understand that.
totally. Okay, so one of the audience was asking what font size do you typically like to invest in, minimum and max? And then I also want to add on that, like, how much ownership do you typically trying to take?
Okay, so our portfolio construction, we titrate the world. We have international managers, as I discussed. We have US seed, pre-seed,
Mhm,
and then the nano fund. Nano funds we describe as sub $20 million, and we anchor those with 20% of the fund size. The smallest nano fund we've done is 5 million. And so, we bias towards smaller funds. The largest fund we have done, I think, is 200 million. That's not our sweet spot, to be honest. That's where funds that have persistence of the returns in the portfolio graduated to. Our real focus is on pre-seed and smaller funds. And so I would say, you know, we don't like to call it a line in the sand or like put caps on it, but I would say there's probably a line in the sand around 100, 125.
mhm,
And that would be hard for us to go up to even at this point. Like for an
mhm,
emerging manager, we really want to see you crawl, walk, run. And
mhm.
so again, 95% of our relationships have started with fund one or two. So it would be on the smaller side. It wouldn't be up to the 100, 125 for fund one, that we would typically invest in.
I wonder, like, so, you know, I guess, like, I have, like, 2 questions before, like, I don't wanna waste too much of your time because we only have a few minutes left. So one of it is, like, what is, like, a typical like, you guys only invest in first and second fund and typically, and then
It's not meant to be that we only, but it's just if you look back, that's what's happened,
yeah,
right? It's
that's yeah, the majority of
yeah.
your portfolio. And like, what if like the fund one just looked like complete trash? And like I heard from like just like dinner drink conversation from like other people, like basically people are looking at you're supposed to be looking at the first three funds or instead of like first one fund because that year may be just terrible or like, the first fund like, and you may just like not know what you're doing. But I wonder like, you guys invest in so many successful funds. Like, what do everybody just like have a really huge
Mm.
success at the beginning? And what if they don't?
Well, by the time you're writing fund two or three, there
Mhm,
really aren't exits yet, right? There isn't the capability of seeing that. I will say, you know, fund one, the most reason not to re-up after a fund one would be it's style drift. Like you said, you were going to do one
mhm,
thing, you did a different thing. Team turnover is the number one thing we see. Like you started with this
mhm,
team, that's no longer the team. You brought in new people. It's just not the same thing we invested in. We give time for the portfolio to mature. That being said, if the companies underlying don't have traction, right? They don't have revenue, there's zero markups, then it will give us pause and we'll have to really dig in deep with you and see if it's something that we would do. I would say that really hasn't happened yet. It really is more on the team turnover, and we don't really have, well underperforming fund ones, I would say. Going back to that, fund ones, just funds 1 and 2 historically have done better. Again, it goes back to fund size, low hanging fruit of the network, everything we've talked about on this. But I think you're learning on somebody else's dime, so you're not going to be given a second chance if you really mess up fund 1. If by the time you go out to raise fund 2 and half the companies are dead and there's no markups, like you've learned on somebody else's dime, and there's just not going to be a second chance. And that doesn't really happen because there is enough time, and hopefully you're good enough at picking. Hopefully we're good enough at picking the people that are good enough picking to where their portfolio isn't tanking in the first 2 years.
I wonder. Okay, so I want to keep the last question short. Okay, so if let's say you have a 50K budget or like 100K budget, how would you allocate it to study how to invest for yourself? Like, would you put in like maybe 10K into subscription of like a really top fund manager into as their LP, or would you just deploy, like invest in like 10 companies or like 5 companies or like invest as many company as possible? How would you go about educating?
I think, angel checks, it doesn't really matter the size if it's 5 or 10, right? So I would do the 5K and I would put it in as many companies as you can, because again, you're trying to show sourcing and picking. And so if you're trying to establish a track record, 5 versus 10, that's not an allocation issue. It's, can you get 100K? And that becomes a big jump, right? And we're going to trust that you can. If we've talked to founders, 100K to 500K, that's a huge jump, right? 100K to $1 million, that's an even bigger jump. So that's really where we spend a lot of time. Like, do you have enough gravitas with the founders to actually get more ownership? But when you're building a track record, it really is showing your sourcing and picking. So I would say I would gear towards smaller checks into more companies, because you're showing that, 5 versus 10, that's not an allocation issue of a manager selecting, of a company allowing you in. I would say that it's more about the showing that you have the sourcing and the picking in those companies.
Thank you so much, Kelli. I really appreciate that you're spending time with us. And at the end, I want to ask, what is your favorite content diet? What do you think all the fund managers should be reading or listening or consuming right now to make them better?
I think it depends what sector. I mean, VC Twitter, obviously. I think it depends what sector you're in. I think it depends what your focus area is. I think there's specific things. Obviously, you can read. There's lots of blogs that we read, but we're allocators. So, I mean,
what do you read?
Every morning, and the first thing is the term sheet and Dan Premack. But I mean, that's just the daily newsletter. Blogs, Tomash is the number one, I would say. But I mean, again, it depends which sector you're going after. So it just depends what sector you're going after.
Okay. So
because I wouldn't go in.
Yeah, keep going. Sorry. Keep going.
Because, supply chain and logistics funds, they should be learning about supply chain and logistics, not just what's going on in, seed ecosystem broadly, right? So I think it really depends what your focus is.
Totally. Okay, where can we find you in the end? How can we find you on Twitter? Please show us your handle.
Actually, I'm not very active on Twitter. Yeah, I'm on LinkedIn.
Amazing. Okay, same here. Okay, everyone, please follow Kelli, and thank you so much. This is such a great conversation. I learned so much, and I'm sure the audience did too. Thank you so much, Kelli.
Thank you, Grace.
Let me end this.